I like how we vibing. I like how we vibing. Yeah. I like how we vibing. Yeah. I like how we vibing. I like how we vibing.
Welcome to another episode of Friday Effects with your favorite practitioner. This week we've got an interesting one. It's what a CFO sees, so the CFO's vision for you and why you should look into hiring one, whether it's an outsourced one or an internal one. Yeah, man. So let's look at it. Anyway, here is what we're covering today: introduction, the financial statements, what the CFO's role is or the CFO's vision, and conclusion. A CFO is known as a chief financial officer. One of the most important responsibilities is to review and analyze the financial statements of the business. That is one of their most important responsibilities. These statements provide a snapshot of the business's financial transactions, position, and allow the CFO to gain an insight into the business's performance and make informed decision about the allocation of resources and management of risk. The financial statements typically include income statement, also known as profit and loss, balance sheet, and cash flow statement. Those are the main ones. There's obviously the equity one and all of that stuff, but these are the main three that everybody knows. We're going to get started with the income statement. The income statement, also known as the profit and loss statement, shows the company's revenues, expenses, and net income over a period of time. This statement is crucial for understanding a company's profitability and how it has changed over time. By comparing the current income statement to the previous one, the CFO can identify trends and make prediction about future performances. This information can be used to make decisions about areas where cost cutting may be necessary or where investment and growth may be beneficial. You never know. The balance sheet shows the company's assets, liabilities, and equity as of a specific date. This statement provides a snapshot of the company's financial position and can be used to identify trends in a company's liquidity. By comparing the current balance sheet to previous ones, the CFO sees if the company's assets are increasing or decreasing and where it has enough assets to cover its liabilities. This information can be used to make decisions about the company's debt, investments, and most importantly, funding. The cash flow statement shows the company's inflow and outflow of cash over a period of time. This statement is crucial for understanding the company's ability to generate cash and how that has changed over time. By comparing the current cash flow statement to the previous one, the CFO can identify trends in cash flow and make predictions about future performance. This information can be used to make decisions about the company's capital expenditures, investments, and cash management. So, those overall are our financial statements. And if you look at our video regarding regarding the financial statements for tax purposes, you'll remember these and examples of these. So I'll link it somewhere just so that you get an overview of what those were like. Anyway, overall, the financial statements provide the CFO with a wealth of information about the company's financial performance, and position. By carefully reviewing and analyzing these statements, the CFO can identify areas of strength and weakness and make informed decision about how to allocate resources and manage risk. This is a crucial function of CFO, and it makes sure that the business is sustainable and profitable in the long run. So that's one of the crucial roles. So yeah. Understanding a business's financial performance and position through the financial statements can also help a CFO make decisions about how to drive growth for that company. By identifying areas of strengths and weaknesses, the CFO can allocate resources to the areas of the business that have greatest potential for growth. So let's say, remember our zero-based budget. So I'll link that here too also, I guess. But remember, in our zero-based budget, we have to start from scratch. The CFO would be very important for that. The CFO would start off by saying, look, we spent 50,000 Rand on marketing over the last 6 months. What is the return on investment on that marketing channel that we spent 50,000 on? And you find that, okay, cool, you spent 50,000, but over the same period, you've only generated 30,000. Clearly, you don't need to allocate more resources towards that marketing channel. Whereas another channel where you spent 50,000, but you've made 100,000 over the same period, then you can look at taking that 50,000 from that other channel that made you a loss and diverting it to this one that has doubled in revenue. It has actually return on investment is twice as much. So you would allocate more resources there so you can generate more money. And that is what a CFO does. Sits down with the financial statements and actually tries to allocate resources to areas that the business has the greatest potential for growth. In this case, the marketing channel that's generating 2x on that return on investment. For example, I already gave you an example, but here's another example. The following examples will actually go down per financials or statement. So it will be income statement, balance sheet, cash flow. So here we go. For example, if the income statement shows that the company is experiencing growth in a specific product line or market, the CFO may decide to invest more resources in that area to further drive growth. On the other hand, if the balance sheet shows that the company has a large amount of unused assets, the CFO may consider investing new business opportunity to expansion to put those assets to use and drive growth. So in this case, let's say you've got a car, the car's sitting there, you're doing nothing with it. So you look at, okay, right now there's an opportunity there's a growth in e-hauling services or delivery services. You decide, you know what, how about we rent out this vehicle to somebody that is in the e-hauling or the delivery business, and they will pay us a monthly fee. That you are using those assets for lease purposes, and it's driving growth because you can actually put your marketing information on that vehicle as one of the conditions of you leasing this vehicles to that individual. One, you're making money on it. Two, you're creating brand awareness. That's something a CFO would do when they're looking at how to allocate and grow your business using those assets. So that's why it's important to have a CFO on it. Furthermore, the cash flow statement can be used to assess the company's ability to fund new growth opportunities by understanding the company's cash position. The CFO can make decisions about whether to fund growth through internal cash flow or external financing, such as loans or equity investments. So yeah, so basically that's basically got to do with how you manage cash. So the CFO can say, look, um, our cash from operating activities is sitting at X, and the cash from investing activities is sitting at Y. We have plenty of cash in the bank. How about we invest in the following asset, and you know in the one period, and then that asset will generate growth over, or better yet, here's a better example. We've got it back to the vehicle section. You've got a vehicle, you're leasing it out. You've got one that you've leased out, and you're looking at the revenue operating the revenue that it has generated over month 1, 2, and 3. You're like, okay, that vehicle has generated 50,000 in month 1, 60,000 in month 2, 100,000 in month 3, from both leasing revenue as well as marketing. So then what do, you simply say, okay, cool. On the cash flow statement, the income from operating activities would be, let's say, 1 million in month 1, 1.2 in month 2, and 1.5 in month 3. You see a steady increase, and you're like, there is a steady increase over that period, and maybe we should consider investing, taking some of those money and invest that money in buying additional assets. Yes. So now from your financing activities, your statement would obviously show a negative there because you're buying more assets. But those assets, they, in the next period, you can expect them to increase the cash flow from operating activities. You see what I mean? And that's how you can use a cash flow statement to assess the company's ability to grow, and also you'll see how much cash you have, actual cash you have at the end of each period. Not because the problem with the income statement itself has non-cash items. So things like depreciation. Depreciation is not really a cash flow item. You can't go and spend depreciation at the bank. You can't, you know, you can't. Depreciation doesn't help you. Depreciation doesn't leave your bank account. It doesn't. So it's a non-cash item. So what a cash flow statement basically does is it takes a lot of the non-cash items and removes them from your profit, and actually now leaves you with the actual cash. This is the actual cash that you spend. This is the actual cash that you received. And like they always say, cash is king. So this statement is very good. And the CFO, how they make use of this statement can either make or break your business. And that is why they're important, they're important in this business. Additionally, CFOs can use financial statement analysis to identify market trends, other companies' financial performances, spot potential acquisition opportunities for growth. It can also help in forecasting future revenue and costs, which can be used to set realistic financial goals for the business. You may want to grow your business from 1 million to 10 million, but yet over the last 5 years you've only grown by, between what are we in 2023, between 2018 and 2023 you've literally grown by like 200,000, yet you want to expand by half a million, I mean 5 million in the next 2 years. From your current trend, it's not gonna happen, but there are certain items from the financial statement that might make it happen. It all depends on how the CFO views the financial statements. So yeah, it generally depends on how they view the financial statements, and they can either make or break your business. So yeah. In conclusion, financial statements play a crucial role in driving growth for a business, By regularly reviewing and analyzing these statements, the CFO can gain insights on the company's performance and make informed decisions about how to allocate resources, manage risks, and these decisions can help drive growth, increase profitability, and secure long term sustainability of the business. So, yeah, so the CFO's insight is very important. You may overlook it as a business. You may think, we're too small, we don't need this. That's how you grow from being small to medium to large. It's simply about the resources that you allocate. And the CFO has the best insight if you do hire the right CFO. And sometimes hiring an external CFO makes it a lot better because they know what other people are doing out there and they're able to apply. They become masters in that field rather than having somebody who's worked for a business in that field. They don't have an outside view of how other people are doing it. So those are some of the pros and cons of hiring internally and also outsourcing. But we'll maybe when we do another video on this section, we'll highlight the benefits and the drawbacks of outsourcing as well as having an internal staff member. The whole point of this video is just to say, hey guys, you should look into getting one. Contact us on, obviously, you can check out our website at www.mcponline.co.za. You can email us at connect@mcponline.co.za, and you can check us on Twitter and Instagram, which is on Instagram, the Compliance Clinic, on Twitter, the Com Clinic ZA, because Instagram, Twitter is a hater like that, but anyway, we love it. So yeah, man. So thank you for tuning in and checking us out for good 18 minutes, maybe more. But yeah, man. Love, peace, and prosperity.